Hello, everyone. Good night, everyone. I am here today with Rob Tatro, Portfolio Manager with the Tatro Wealth Advisory Group, and yours truly, Tanya Tatro. I'm an advisor with Canaccord Genuity and the Tatro Wealth Management Group. And tonight, Rob and I are going to chat about all things markets, business. We're going to take some questions from our viewers and or listeners, I guess you could say. So maybe before we get into some of the really fun stuff, Rob, what have you been up to these days?
Well, it's been a busy time. I've been taking water out of my neighbors' basements and checking on their sub pumps and stuff. Thank God we've been dry. I've been training a lot. I got a triathlon, an Ironman triathlon coming up in 6 weeks. So that's basically been my life because it's kind of 2 hours a day ish. So I get up early, I do that. Weekends, I do long jogs and runs. How about you? What have you been up to?
Well, we're really busy around in our neighborhood here. I'm in the same boat as you. My basement is still dry, but I've been kind of helping everyone else out too. I'm still
Boat?
doing my training.
Saying
What's that?
boat? I see what you did there.
Yes.
Boat?
Oh,
Saying
yeah.
boat?
See, nice. I
Yeah.
didn't even do it on purpose.
That's okay. You still take credit for it.
But I'm not training nearly as hard as you these days. You haven't even really, you should take like at least 30 seconds bragging rights for your last marathon. At least that went pretty well, right?
Yeah. I mean, it was unbelievable. I ran a 3:23, 3 hours and
Very
23
proud
minutes
of you. Very
at
proud of you. It's
Mount
pretty amazing.
Charleston in Vegas, just outside of Vegas with my brother Charlie. We beat our personal best by 34 minutes or something. It was just a great day that, like, for me, it was the first time I was taking gels and they have a bit of caffeine in them. And I didn't know. And I was like, I was like, wow, I feel so good. I feel so good. And I had new shoes and like I don't know, placebo effect maybe. And I had done a ton of training. I slept so good. So for me, everything lined up perfectly and it was a personal best. And I really look forward to hopefully doing a 3:10, which would qualify me for Boston. So I'm excited about that. But for now, I'm focusing on my Ironman, which for those of you who don't know, it's 3.8 kilometers swim, 180 biking kilometers, and then a full marathon, 42.2 kilometers after that. So they give you 17 hours to do that. I hope to complete it. That's my goal.
Oh, that's amazing. My hope is actually I like to run a little bit more as well during the summertime. I like to lift weights in the winter and then run, especially like trail running and stuff like that in the summer. But I have a little project right now is I'm going to learn archery with my son.
Oh,
So
nice.
he told me that he wanted to learn archery. So I said, okay, well, I'll go and I'll
He's
learn
going to
too.
be so good. Thaddeus is going to be so good at archery. I just have a
Yeah,
feeling.
he just has to like learn to focus for more than like,
Yeah.
the 10
Details.
seconds that a 6-year-old can actually focus, right? Yeah.
That's great.
So we'll see how that goes. Um, what a week, right? It's been a little bit crazy. When's the last time you saw this amount of just daily volatility, just kind of like up and down, like hour to hour in the market?
March 2020, I'd say March or April 2020. Those were very, very volatile times. And you're right. We've been on a bit of a cruise control here now for 2 years. So it's easy to forget. It's easy to forget that if you're invested in the market, you get the good, you get the bad, right? And there's
Yeah.
what is it? The Facts of Life. There was a show that used to go like that.
Yes,
You
yes.
take the good, you take the bad, you take them both, and
Both
there
in
you
there you
have the
have.
facts of life. So we forget, right? It's too easy sometimes. It's too easy to just make money and like just put that in your and just see the balance going up every single month for like 24 straight months. And you sometimes forget that there are sometimes pain points if you have an equity portfolio, if you own stocks and the market corrects 10, 15, 20%, that's going to impact you. And that's what we're seeing right now. And you're right, it's the volatility, but I think it's the fact that I think investors generally have become a little like, turn the blinders on and this is going
Yeah.
to go on forever. And it never does. It never
Yeah.
does. Right.
We've been a little kind of spoiled over the last, other than March 2020, the last decade or so has been a nice little run there. So yeah, we forget how that feels,
But
right?
even in the last decade, Tanya, like you remember 2018
Yeah.
December, we had a 15, 20% correction,
Mhm.
25 maybe even. It kind of went like that, came right back. 2015 was bad. 2011 was really bad.
You're right. It's
2011
funny how fast
August.
we forget, right? Like it's
Yeah.
almost like we don't remember anything past like a year ago or something like that.
But we can't forget that we always go through this every single time. 2013 was a bad run. 2008 was really, really bad. So, I mean, I know that it sucks right now. I'm not trying to make light of it, but clearly you and I have been here before, and it's, for now, what we're doing is, protect downside, manage volatility, make sure the asset allocation is right, and look for opportunities.
Yeah, that's a pretty great summary right there. Let's hope that we're going to get some questions today. So I would like to just kind of give a shout out to everyone, whether whether you watch us all the time, whether you're one of our clients and you follow us. We really want to just open a discussion with everyone. So make sure that you just post your questions in any of the comment sections, Facebook, YouTube, Instagram. I'm trying to figure out like where we're actually being broadcast right now, but I think it's on all the social platforms. So go ahead, post some questions, and we'd love to help you out and just kind of get that dialogue, I guess you could say, going. Especially if you have either questions or comments, we want to hear from you. In the meantime, where should we start with this crazy week? Are we actually going to get through the next hour, do you think, without mentioning Elon Musk?
I've spoken about him so much on the morning.
Me too.
Every morning on Global News, they ask me about Twitter or Elon or Tesla or crazy.
So maybe we don't want to start there. I don't know.
Well, yeah, I don't remember. And maybe you do. I'm trying to think the last time I saw a company that big go public this kind of late in the stage. Go private this kind of late in the stage. Like, companies don't go public to then go private. It's so rare that happens, right? And the premium that he paid, those of you that followed, we said we would talk about it. Here I am talking about it already, right off the bat. The premium that he paid is relatively small when you factor takeovers, acquisitions. Usually you're looking at a 25-30% premium. And this premium was a few dollars per share. Just a crazy, it's almost like I felt like when I watched it, it was like someone who was, drunken promises type thing, or like des promesses d'ivrogne, we'd say in French. We're like, oh, I'm going to buy that company. Yeah. And then like the next day, I said I'd buy it. Guess I'm committed to it. And, it's $44 billion with a B. Just cut a check. Don't worry about it. He's not even raising capital. He's just cutting a check, and he's doing it with debt. So
I think that's the other part that was so surprising. It just happened overnight. It literally happened overnight.
Crazy. That's a crazy story. Yeah.
Oh, looks like we got a question already. Oh, you've been saved by the bell. Saved by Carrie, actually. Carrie has a question. Is it too late to go into the energy sector? What do you think about the financial sector, and specifically talking about Canadian banks and US banks?
So I'm kind of happy that we start with an energy sector, because those of you who didn't know, we just released the interview with Eric Natal on our YouTube channel yesterday. Check it out. If you haven't checked it out, Eric Natal, he's the synonymous and ever raging bull, Robert De Niro style, raging bull on energy. He's been a bull on energy for his whole career. He runs the 9 Point Energy Fund, just released it on the YouTube channel. Check it out. It's a half-hour interview, and he runs the portfolio, and all he does is oil and gas. And he was, I guess, glowing when I interviewed him last week, I think.
And that's on the Rob Tatro YouTube channel, right?
On the Rob Tatro YouTube channel. Yeah, check it out. His opinion clearly is there's so much more room to run here. We're looking at, I was chatting with Wayne Stushnoff, my branch manager, my colleague in Calgary, and he was just talking about how the city is lit up right now, and how, companies, small cap companies, are paying off their entire debt this year, or micro caps. They're paying off all their debt, and they're going to be able to produce like 50 cents cash flow on the dollar of equity kind of thing. So like a 2-year payback period on some of these companies. So they're forecasting models at $75 or $80 for WCS, which is Western Canadian Select, which is the Canadian oil price. So if you think that oil can stay here or not drop below $75 WCS, and you trust that management is going to efficiently manage the capital, that is, not blow it all on capital expenditures, and if you believe that demand for oil is not going to taper immediately, like in the next month or 2 or 6, it's not too late to get into energy, because there's a ton of room where that's going. Companies are trading at 3 or 4 times earnings, which is kind of unheard of in this traditional sector. And the reason they're trading so low is because oil has been taboo for so long. There's so many
just out of favor.
Out of favor. It's not, they weren't profitable for I don't know how long. And it's, so, I mean, our view is this. I would first ask Carrie, what percentage do you have in your portfolio currently of oil and gas stocks, direct or indirect? And then are you overweight, underweight, or market weight? And if you're underweight, I'd say take a look at maybe adding some names. And then if you're overweight, I'd say, you're probably doing okay to be overweight. I mean, we did some trades for some clients and those positions have almost, they're up 40 or 50% or almost doubled. So
Yeah,
do
almost
you want to
double.
start?
Some of them are, like 80% up. It's
Yeah.
crazy.
Do you start trimming those? Maybe you could consider, but you definitely want to own oil and gas unless you're morally opposed to owning those companies. I don't know. What do you think, Tanya? Or sorry, it's your show. I should shut up here.
Well, no, I was actually going to ask a follow-up question on that because you kind of mentioned some two kind of if-thens in that, if you think that the demand is not, going to take like a steep dive right away, and if you expect that management will be able to kind of deal with, the financial and business aspects of this in the next market cycle.
CapEx. Really, it's the CapEx, capital expenditures. They got to maintain that under control because every time they go through this cycle, sorry to interrupt, every time they go through this cycle, they always, all of a sudden they're flush with cash and they go, blah, and they just dump it in whatever, billion projects.
Well, that's exactly what I was going to ask you. What do you think those prospects look like now? Do you think there's a lot of good lessons that have been learned the last little while?
100%. And this was one of Eric's points on the show, that on the episode that we released. He says that shareholders and the boards are so tight and they're so concerned about CapEx. They're reining in CEOs and management, and they're not allowing CapEx because a lot of times you do these CapEx projects and it's a 10-year payback or a 15-year payback. Well, that's not great for shareholders today if you just want to get your money out of your company, right? So you could buy a stock of a micro cap it's going to pay you back in 2 or 3 years. Do you really want them to spend $1 billion on a project that's going to pay itself back over 15 years? Maybe you do, but maybe you don't. Maybe you just want to get that capital back and end it. So they're being extremely defensive with their CapEx. If they continue to do so, I think there were 3 what ifs, right? 1 was the demand. 2 was the management maintaining their CapEx. And 3 was price of oil maintaining above 75 WCS. If you get all 3 of those, that's a winning formula for oil and gas stocks in Canada, regardless how you feel about the industry or what they're doing to the planet. And Eric, on that point, Eric spoke at length about how this is the cleanest, he was saying, this is the cleanest oil on the planet. Why would we want to, buy it from Russia? And we've seen their track record, right? They're, murdering civilians. Why would we want to buy it from that company? Who knows how they're getting their oil? We have no track record, whereby here he was arguing that the oil is a lot cleaner because we respect this, his argument, they respect the ecosystems and, they try to be carbon neutral, etc. So anyways, that's a long answer for you, Carrie.
Well, let's look at, before we jump to Jay Cabral's question, let's actually finish Kelly's first questions, which was Canadian and U.S. financials. What do you think of that sector?
Canadian U.S. financials. So I think you always need to own Canadian and U.S. financials. I would never take aggressive position Canadian or U.S. financials unless they fall significantly and you're a little fearful of the market. So one thing I said on March 23rd, 2020, as I said, listen, there are generational opportunities to buy stocks right now. If you don't know where to go, but you got cash, just put it in Canadian banks. They're down 40%. You're not going to regret buying a Canadian bank at a 40% discount. I would say the same thing now. So they're not nowhere near that type of discount. I think you should own Canadian banks. I think you should own US banks. I don't see right now as being, more heavily invested or less heavily invested in Canadian banks. I think you need to own them. And I think just make sure you own a percentage of them. That's probably 25 to 35% of your Canadian equity should likely be Canadian financials.
Yeah, I like that. I would tend to agree.
And if they keep dropping and you're fearful, because here's what's happened. When the market corrects, you're going to be fearful. You're not going to want to put your money in the market, Carrie. So you're going to be like, you know what? I'll just wait for this thing to figure itself out. But by then the stocks are ramping up. You're like, I missed it. It's too late to get in. So if they keep correcting, put some money in Canadian financials if you're worried about investing in the market generally.
Yeah, I think that's definitely a good idea. And even without a marked correction, it's not a particularly risky prospect to think about having a percentage of your assets in Canadian financials, regardless of the price either, because when you're building a diversified portfolio, you're going to want that in there anyways.
What would our dad say if you were here right now? You got to own Canadian banks. You just have to have a whole bunch of Canadian banks. And when they fall to a 5% yield, you back up the truck. I say that you back up the truck. That's what Claude used to say, my dad. And for those of you that don't know, my dad is on the team. He works for the Tatro Wealth Advisor Group, and he's the what would we call him? The senior sage.
I would call him the OG,
The
maybe,
OG,
you know.
yeah. So he's not here today, but we talk to him every day we talk to him regularly about the market. And I know he would say that about Canadian banks. I've heard it so many times.
Yeah, absolutely. And we've done well because of it. So, all right, we've got a second question here. Ooh, this is a good one. Fun stuff. A $2 million windfall. What do you do? I think we might have a video on that, maybe.
I think we do too. So first off, congrats on the windfall. Hopefully it's like you sold a business or sold land or something. Second question is, I would suggest take a chunk of it and go blow it and just have a great night or a great weekend somewhere in Cancun or Europe or something. Spend something that you're going to feel good about yourself. After that, you probably want to preserve that capital. I would ask you, what's the capital for? Is it long-term investments? Does it have a short-term horizon? Are you saving some of that to buy real estate? Are you going to pay some of that debt down? Assuming you're not, assuming the entire thing goes into the market, here's what I would do. I would make absolutely sure that you allocate some portions of assets to stocks, a portion to fixed income, a portion to alternatives. I would leg in the equities, the stocks. So I would take my time to purchase equities. Your biggest risk, if you have a $2 million windfall, is the market timing risk. The risk that you're buying today, potentially at the wrong time. So if you bought on March 23rd, you did unbelievable. But if you bought like on February 10th or wherever the high was, I think it was February 7th or something, you actually you were down 40% a month and a half in. So that's market timing risk. Now you're still way up, even if you bought on February 9th. But what I would suggest is legging in. So you do a period of time where you leg in the stock. So you buy a bit today, a bit in a month, a bit in another month. And every time the market corrects a certain percentage, you keep buying. Because the key is you want to be fully invested, but you want to reduce market timing risk. I would certainly buy some alternatives because it's $2 million. You're not going to be able to shelter all of that in registered accounts, RRSP. So that means you're going to have non-registered assets, either in your own name or in your joint name or in a corporation. And that means you need to factor tax because the income that's going to be generated is going to be taxable. I feel like I'm rambling here, but these are all important things. So the tax, you want to asset allocation, you want to make sure you leg in, and you want to make sure you're being tax efficient on your investments with alternatives. So all that should give you some capital preservation, some growth, and enough tax efficient income to likely fund your retirement if you're retiring. How about you, Tanya? What would you add to that?
I think you covered pretty much all of the points, but of course you have to also, as we ask the question of what the time horizon is going to look like on this, what do you want to do with this money? Might not be a bad idea also to have a chat with your financial planner as well, and figure out the big picture before you actually start building out this investment strategy, because that's really going to help you with the last point that Rob mentioned, which is tax efficiency. So that would be the one additional point that I would add to that.
You're so good at this, Tanya. That's such an important thing. And that's such a good point. You always think of that kind of stuff. Good for you.
I feel as though a big part of this business, and I think one of the reasons kind of why I like it so much, is that we're able to kind of just take a lot of stress off of our clients' shoulders. And I think a lot of that is, planning related and just is big picture stuff. So I think that kind of stuff's important.
On that note, I had a call today with a client, and she opened up to me a little bit, and she says, you know what, I got the blues a little bit. I'm a little down with just generally. And I said, well, part of that is seasonal. I think part of that is, I think you need to, go out and play sports and whatever. But part of that is we've had such a good period here in the market that, now you're faced with, and you kind of forget that this is normal. This is part of it. So we didn't talk about, what position should we add in our call today? We didn't talk about adding stocks or alts or whatever. We just talked about, hey, you're in a good spot. You've done well. You've saved a lot of money. We've looked at the plan. There's enough here. It's going to generate tax efficient income for you. You're in a good spot. You don't need to stress about this. You don't need to look at this every day. You don't need to. And she was like, yeah, okay. Yeah. It's just what I needed. So you're right that sometimes our job is and I love that part of it too.
Yeah, that's my favorite part. We get to talk about, all the fun stuff that people will eventually get to do with the money that we're growing. So it's fantastic. All right, we got another question here. This one's from Brian Humphreys. Question is, how much further do we think the large tech stocks will fall? Some of them appear to be approaching more reasonable PEs, such as Netflix, Meta, Facebook, Google. This is actually perfect. I'm so happy Brian asked that question because that was going to be one of our topics this week because it's been a mega tech earnings week, right? And so a lot of the volatility we've been seeing is related to all these announcements. And we've been seeing kind of both directions, right? We saw Netflix just surge, but Amazon was kind of down in the dumps a little bit. So thoughts on that, Rob?
Yeah, so let's start with, this is a great question, Brian. Let's start with some of these PEs. So if I pull up Meta, the price to earnings for Meta, otherwise known as Facebook, today, according to my system here, 15.5 times earnings. The stock, we know it got hammered. This was almost a $400 stock like 6 months ago, and it's now a $200 stock. So it's down almost 50% in a few months here. Netflix, it is trading at 18 times earnings. And if I look at kind of the 1 year number, it was a $700 stock that's now trading at $200. So that one's down a boatload. Google is trading at 20 times earnings. It was a $3,000 stock. It's trading at 2,300. So those three, if we use those three as an example, they're down a lot. They're down a lot. I mean, some are way worse than others. I would tell you this, Brian, not all tech stocks are the same. Those three are not the same as, smaller cap growth that are trading on a multiple of sales, or fintech, or emerging businesses.
Like a Robinhood, for example, today, or like a Pinterest.
Yeah.
Well, maybe, yeah.
They're profitable. They have a long track record. So I would say, let me ask you this, Brian. If you could buy a company that's growing their earnings at 23% year over year, has had 60 consecutive quarters of increase in revenue and increase in earnings, and you're buying it at 15 or 18 or 20 times earnings, would you want to own that? And I think most people would say yes, because you're buying retailers or you're buying financials, you're buying those at 8, 15, 18, 20 times earnings, but they're not growing. Or if they're growing relatively small, whereby unless you believe that growth is not going to continue. So they're not all the same. And I don't want to comment too much on a specific stock, but I agree with you, Brian, that some of these tech stocks are starting to look like buys. And if they continue to drop, they're going to look like screaming buys, because are you going to regret owning Google at 2,300 in 5 years? No, you're not. You're not going to regret owning, whether you paid 24, 22, or 2,300. It's not going to matter. And I said this on BNN 5 years ago. I said, are you going to care if you paid 600 or 700 for Google in 5 years? I said, no, it's not going to matter, because the stock will be at 3,000. That's kind of what I said. And it happened. And I do believe companies like that control the data, are able to monetize different portions. They have so many revenue streams and so many revenue streams that we don't know yet. I do think that if you don't own, Google, for example, it'd be a stock to add right now.
No. But I think you raise an interesting point there, is that they are certainly all different. And there's, you want to look for things like competitive advantages, multiple revenue streams, good cash flow prospects. And not all of those tech stocks will necessarily fall under that category, right?
Yeah.
All right. So let's see.
I'm just going to get my door.
You got a little bit of background noise there. So while Rob's doing that, I'm going to give a shout out to everyone who's listening and see if we can get some more questions coming up here.
Don't forget to like and follow and all that fun stuff, right?
Oh, yeah. All right, here we go. We've got another one from Orion. Would you sell or trim Nutrien at this point? Oh, now we're getting specific stock questions.
Yeah, I'm not going to address this one. There's so many compliance issues with me giving stock specific advice. I don't know your personal situation. I don't know how much of it you own. I don't know when you bought it. I don't know if there's tax implications. So I can't really give you advice on that. I can tell you generally, if you believe in the commodity cycle, if you believe in the commodity cycle, Nutrien, that's the old potash, the story, if you believe in that cycle, the story's not done. The story is similar with potash and with, an aluminum producer, lumber, all the resources that are being produced in Ukraine, and then they're kind of less in demand now. The story is the same, right? Because the price is going up. And if you have that commodity, if you have that finished good based on a commodity that's rare, from Ukraine, in theory, the company should do well. But again, I don't know your personal position and I don't know what's going on there. I actually had a great talk today with one of the executives at an ag company. He was telling me, we talk about inflation. So the reason that Nutrien has increased so much is because the price of potash has increased dramatically, because the stock is up, I think 100% in the last 8 months or something. And it's up like 300% in the last 2 years. But potash, so they control potash. They have a ton of potash, but like so inflation has caused potash to be worth more. And then, they're selling that. Not all inflation is the same, right? Because we say, oh, inflation is great for ag producers. Well, not necessarily, right? Because some of your, this particular ag producer needed one commodity to operate, and their selling product, they had one finished good that they were selling.
Yeah. So it depends on where they are in the supply chain, right?
Exactly. And the one that they were selling, there was inflation, 5, 6, 7%, but the one that their input costs were up 25%. So yeah, they were getting 7% more, but they were getting squeezed on margins. And it's not like these numbers are so big, this inflation crisis because of Ukraine and Russia, that it's hard to read this without going into the details for some of these ag companies.
Yeah, you would almost have to be really an expert in that actual sector to be able to really see all the data there. Yeah. So since we're on the subject of inflation, should we talk a little bit about that and how that is going to affect, investment strategy moving forward and things like that?
Yeah, I have a question here from a client that came today, basically asking me, can you talk about how my portfolio is likely to be protected against inflation? Now, I'm not going to talk about this guy's portfolio specifically, but
I got the exact same question today, so that's good. Yeah.
We can maybe talk about our strategy and what we do to protect against inflation. Do you want me to handle it, or do you want to say what you told your client today?
Well, I mean, let's start first of all with, how do we look for asset classes and or specific investments that would be a hedge against inflation? So maybe I'll let you kind of go towards that, because diversification would be kind of like, our tool for that. And we want to make sure that we're being deliberate about that when we build out the portfolio.
Right. So what is inflation? First off, inflation is an increase year over year in typically the CPI, the cost of goods. It's not just the increase in cost, but it's the depreciation of your purchasing power of your currency. So $1 last year could buy, or let's say $100 last year could buy 25 Big Macs. This year, it can only buy, 24 Big Macs. Therefore, our purchasing power gets eroded year over year. So that's fine, typically year over year, if it's a reasonable amount, a target range of 1% to 3%, which is what the Bank of Canada kind of aims for. It's when you fall outside of that range that you get problems. Why? Because as consumers, if our cost of goods go up 6 or 7%, and we're not seeing that in our salary increase, now we have to cut spending, right? Because we can no longer spend the same amount because our purchasing power is less. So that means we're spending less. And anytime you get less spending, hopefully you know what that means. It leads to either a recessionary environment or an economic slowdown. Companies have less profits. If I buy less burgers at McDonald's, I don't buy burgers at McDonald's anymore, but if I did, there would be less purchase next year because of inflation, and therefore they get less sales, therefore their earnings are worse, therefore their stock goes down, etc. So inflation is a concern. Serious inflation is a concern. Now, how do they combat inflation? They typically combat it with monetary policy. They'll do one of three things. They will either increase interest rates, they will reduce the supply of money, or they will reduce the supply of liquidity in the capital markets. They will stop buying bonds. So these are the tools that the government, the central bank, can do to limit inflation. Why? Because inflation is more dollars chasing fewer goods, as my dad used to always say. Very simple. If ever you're not sure how inflation works, think of this one sentence: more dollars chasing fewer goods. That's it. So if you have one of these and you have an extra $100, this is going to be worth way more, and you get inflation. So the problem with inflation is you have stocks that are in one sector, a sector that is typically growth. The growth sectors, they get hammered by inflation. Why? Because the long tail of the earnings and the potential future growth of the company is worth less if you're eroding your purchasing power by 7% per year. I'm using 7% as an example, whereby, a traditional company that is based on a current net present value of their earnings is going to be less impacted by that, right? So like Google, the reason Google stock is higher is not because it's going to be ridiculously profitable next year. It's because anyone who owns Google, is buying Google, is thinking in 10 years and 15 years from now, that's going to be a crazy good stock. But if in 10 and 15 years from now, $1 of earnings is only really worth 40 cents, well, it's worth way less today. So it's the net present value of that future dollar gets eroded. Wow, that's very complicated, but hopefully I didn't lose you guys.
No, but this is good. Now you've got the context. So now,
okay, so context, yeah.
What's the strategy?
So what do we do? Yeah, I thought it would be important to give an economics.
No, but that was very good context, because now we know what the solution is going to be, right? The solution.
Yeah. So the solution is you invest in assets that hedge against that naturally. The easiest way, you may have heard this in the past, is real assets. Real assets, typically real estate, infrastructure, and commodity-based investments perform very well in inflationary periods. The reason being is if you own a house, there are fewer goods, right? There are the same amount of houses. So let's call it the same amount of houses, but more dollars chasing those same houses. What ends up happening? Those same houses are now worth more. If you throw in $1 trillion into the capital markets or into Canadians' pockets, they're going to be much better positioned to bid up houses, right? To bid up used cars, to bid up new cars. That's why you see those things appreciate value. So if you own real estate, same amount of real estate, more dollars, the real estate goes up. Same thing with artwork. There are only 100 Picassos, right? Same amount of Picassos, you get more dollars chasing those same Picassos. Art does very well in inflationary periods. Hockey cards, collectibles, Magic the Gathering cards, these are all asset classes that perform well in inflationary periods. We don't invest in those for our clients' portfolios, but let's talk about some that we do: real estate, infrastructure, and then commodity exposure. So that's how we do it. If you own a private REIT with us, they're up 20%. Some of them are up 20, 25% in the last year since inflation started. They're doing quite well. It's proven to work right off the bat.
Now there's another benefit to that too, because when inflation goes up, the monetary policy is then to bring the interest rates up. So now you also have kind of a second advantage, especially if your real estate is multifamily housing, because now you're in a situation where, people may need to rent rather than buy. And so now you're on the other side of that trade. So it's kind of like a double whammy there too.
Yeah. We're always hoping that people don't lose their houses and go into and need to rent. But if it happens, if you get into a recessionary environment, it does wonders, because people don't own their house. And the other thing that happens in an inflationary environment is you used to charge $2,000 for rent for a 2-bedroom. Well, guess what? Now you could charge $2,200, right? So what that does is that $2,200, it's a multiple of your net operating income, and your real estate is now worth more, 10% more. So all that to say that we believe in that. You've heard me say this on this show, on BNN, on Global News. I've said it. I've been saying this for 10 years now. It's a great hedge against inflation. It's a great way to protect capital. It's uncorrelated to the markets. All of our clients own some. And depending on where you fit in the risk scale, you might have, 10, 20%, you might have 30, 40, but regardless, we believe in it, and it's done wonders for our clients.
Now, the other thing that we haven't really talked about is that there can also be some stocks and some equities that aren't necessarily commodities, but that can do reasonably well if you're not looking at, like a tech company that you're looking at really like forward growth, right? If you're looking at something that's more along the lines of consumer goods, where, those kinds of things. So those companies could be reasonably a reasonably good choice within a diversified portfolio as well, right?
Absolutely. I should have mentioned that. Thank you for
your Walmart. They're gonna start charging more, right?
Yes.
Or these companies. So
anyone who's got brand power and anyone who's selling a consumer staple, right? So like, I need to shop for groceries, I need to buy pickles, and I need to buy ice cream. And if the ice cream's $5 or $4, we're still buying the ice cream. So that they're going to pass on the inflation to the consumers, and they're just going to have more revenue. So absolutely, that's a good call, Tanya.
Yeah. So this is where you want to be on the investor side of thing, and not on the consumer side of things.
Maybe we should talk real quick about two of the other ones are infrastructure, same thing. and then music royalties, right? So
Oh, yeah.
music royalties, if you own this, it's a niche. It's very, very nichey, and some of our clients own it. And the same theory applies to music royalties, right? So if the kind of going rate for a royalty used to be, I have no idea, 2 cents a song, or maybe it's $1 a song, whatever. Maybe next year, instead of it being $1.02, because it'd be 2% inflation, it's in higher demand, same amount of songs, more dollars going around. It's now $1.07 a song. So you do get that same thing. Same amount of songs. Scarcity is important when you get to inflation. Same amount of songs, more in demand, more dollars going around, you get the inflation. Same thing with infrastructure, right? So if you own a solar panel company, or a toll bridge, or an airport, or a pipeline, there's only one of those, right? And you need to either pass boats through, or cars through, or I don't know, planes
Energy,
through,
oil, whatever. Yeah.
whatever you're passing through that infrastructure project, I should say. Again, there's only one, there's more dollars going around. We need to use that. You're going to pay more. So those infrastructure plays are great. Private infrastructure we believe in, and we've owned BIP.UN for a very long time too, Brookfield Infrastructure. So it's all stuff we believe in. And it's a great hedge. Bunch of different ways we can hedge against inflation.
Yeah. And let's just also talk about how the worst thing you can do in an inflationary, economic condition is to not be invested.
Yeah, because what happens? Your dollar's worth 7 cents less next year, and
You're
made
guaranteeing,
zero.
you're guaranteeing yourself a negative return.
Yeah, I used to say, like, back when, I still say this, you get a 2% bond in a fund or something, or an ETF. It's a government or a corporate bond. It's 2%. You get fees of 1 or 1.5% on that, right? Then you get tax on the 2%. Then you get inflation of 2%. So you're actually holding an investment that guarantees that you're going to be negative. You're going to generate negative returns in the following 12 months, guarantees that you're going to generate net negative returns. Plus, if there's increase in interest rates, if you don't know this, I'm telling you, interest rates hikes are bad for bonds. They're bad for fixed income. So you end up exposing yourself to a risk that you probably don't even know. And yet we see it all the time in statements, all the time, these 40%, 50%, 60% of their portfolios in like long-term government bonds. And those Canadians right now, those retail investors, are getting killed as interest rates are going up. Unfortunately, they bought what they thought were safe assets, and they're down 10% or 8% on their guaranteed assets. It's crazy.
Oh, we've got another question from Brian. There has been a lot of hype with electric vehicles over the past year, and I'm hearing more and more people moving forward with an electric vehicle. If you feel this will happen over the next several years, what are the options to capitalize on the shift from oil to electric? He's given some ideas. Here's some good ideas: lithium batteries, electric car manufacturers. So, well, it's a really good question, because it's essentially kind of a developing industry, right? So I'd love to hear your thoughts on this, Rob.
Yeah, I'm just trying to pull up this, but okay. So this is a great question, and one that I asked almost directly to Eric Nuttall. So the thing with vehicles is, we all think as investors and as consumers that oil goes into vehicles, right? We think that gasoline goes into vehicles, and that's what it's used for. I don't remember the exact percentage, and someone will correct me on this, but I think it's something like, is it 20% of the global use for oil goes into vehicle? Maybe it's less than that, 15 or something like that. Regardless, it's a relatively small amount,
and it's probably smaller than, let's say, like air travel and all of that stuff as well, right? Yeah.
Yeah,
so it's probably way a small portion.
But what's actually happening is there's an emergence of the middle class happening in a whole bunch of countries across the world. Just like North America went through this in the kind of 40s, 50s, 60s after the war, where there started to be the suburbs, and the 2-car home, and the TV, and the 2-car garage. Well, this is starting to happen now in a whole bunch of countries. Has been happening. And what's happening, as you get more and more middle class, more and more spending, more and more consuming, more and more oil and gas use for stuff like factories and production of goods and transportation of agriculture, and like the whole rest of the pie. So his point, and I'm not going to pretend I'm an expert in oil and gas. I'm not going to do that. And I don't want to get called out by anyone who tells me that I'm polluting the planet with this opinion. I'm just simply saying that the switch from electric cars is, one, it's not going to happen overnight. Unfortunately, I wish it did, but it's not. It's going to take a long time for China and India and Brazil to completely shift to carbon neutral or even electric cars. Like, it's not happening tomorrow. So you get that entire slowdown, and not only that, but during that time, you get growth in the combustible oil segment. So you're still growing that sector right now. It's actually, unfortunately, not shrinking. So I don't think there's a significant play to be made there yet, because it's already kind of happened. The first bump on lithium and all that happened last year or 2 years ago. I'm getting old. Maybe it's 3 years ago already. These stocks moved a ton already. And, now it's, they've tapered off a little bit, but I think now they're likely more properly priced than they were. So if you truly, truly believe in this, I would buy one of the ETFs. Like Evolve has a really good one. I believe it's called, is it Auto or something like that? I forget, but Evolve has an electric vehicle ETF that's good. And there's a whole bunch of other ones. You buy the sector as a whole, and you hope that the sector as a whole goes up, because some of these companies will go bankrupt.
Well, that's exactly what I was going to say. This is really, really important, because, if you don't do the ETF and you don't, get exposure to the entire sector, you're going to be stuck having to just make a choice and gamble on which one is going to be the winner, right? So you're going to be better off getting more diversified exposure if you do want to go that route, if you believe in it.
Yeah.
All right, we've got another question. For someone with little US exposure, which sectors or stocks would you recommend considering? Or would you just buy the whole market index?
We believe we're asset allocators as a whole, first and foremost. So we allocate assets. We are never going to make like dramatic, significant sector calls, and we're never going to have 50% of our money in one sector or one index. So I would tell you, make sure you have some of everything. But I would also tell you, we've talked about some of the undervalued sectors. If you're going into the US now, take a long, hard look at some of the large cap tech. Take a look at some of the energy names. Now, the energy story in the US is a little different than the energy story in Canada. The large caps are more like, they trade a little bit more like Canadian REITs almost. They don't trade. They're not as volatile as Canadian oil and gas stocks. But just make sure you own some of everything, and then take a look, maybe going a little bit overweight tech and maybe a little bit overweight energy. And there's your portfolio, right? So I would definitely make sure you have some financials. Make sure you got some consumer discretionary, some consumer staples, some materials, some mining. Make sure you're exposed, some real estate. But we talked about some sectors that I think are undervalued.
Yeah, those are some good comments, Rob. Thanks. Oh, we do have another one. Oh, Richard Gagné. All right. What are your thoughts on how the aging population will affect us here in Canada? Specifically inflation, opportunities, etc.
Okay, so
like the baby boomers retiring, that kind of thing. Yeah.
There's going to be so the transfer of wealth is one thing. So the transfer of wealth that was predicted to happen kind of now is being delayed because Canadians are living longer than kind of were expected. So that's one thing. So the transfer of wealth to individuals in their kind of 50s, early 60s, and some of those were planning on actually retiring on that wealth. A lot of the parents are now outliving the retirement of their kids, right? So you live till 90, 95, you had your kids when you're 20, 25, your kids are now retired by the time you transfer the wealth, and they don't even need it. So sometimes it's jumping a generation. Sometimes the wealth transfer is jumping a generation. That's one big thing on the planning side. Second of all, I think there's going to be tremendous opportunities in certain sectors with the aging population. Senior assisted living, real estate is one area. We've done a few private deals in that space, and I love that space because they're really good clients. They tend to not move that much once you're in your 70s or 80s. And they need really service, and they're usually wealthy enough to pay. So you have very little vacancy and delinquency on your rents. Some other, I think the question is it?
That's a very generalized question. Just how it will affect us. Let's see. We've got the question actually coming up right here. How it will affect us here in Canada, and I think he also put
inflation opportunities. So the aging population, in theory, shouldn't cause inflation, right? Because if we think of inflation, more dollars chasing fewer goods. I don't think of the aging population as being those that are chasing those goods with their dollars. I see them more as preparing for a wealth transfer. So the assets are likely in the stock market or in bonds or in GICs or in term deposits. So the wealth is accumulating. I think my guess would be the wealth is accumulating on the balance sheet that says liquid assets investments, not in, Starbucks coffees and trips and luxury watches. So I don't think they're going to cause inflation. I think if anything, the older your population get, what would cause inflation, I think, is if you had a tremendous transfer of wealth right now, and people my age would get a ton of money. Yep. I think you would see inflation, because now we'd go out and spend it because we're less trained than the earlier generations, and we would spend the money. So I don't think inflation, it's likely deflation. I would imagine as the population gets older, and I don't know this.
Yeah, there would be less dollars chasing kind of the goods that younger people would.
That's my guess. And someone's probably studied this, I would imagine, and can correct me if someone has.
But there might be some effects on things like, the job market and just the economy in general. But that could be a really, really long discussion.
Well, and the other thing that's happening is a lot of Canadians built their plans in the 80s or 90s, and they were using fixed income back then because you could get 8, 9, 10% on your bonds. And the planners were using 8, 9, 10% return. So you could, if you had $1 million, you could take out 80, 90 grand per year of income every year. And what's happened is if they kept taking 80, 90 grand out, and they're going to outlive their savings. This is going to happen with some part of the population, especially the part of the population that had a portfolio of traditional fixed income, because now their bonds are worth way less. They've been pulling out 80, 90 grand, and that's eroding the capital like crazy. So
and they're living longer and longer, and
they keep living, and there's no, so now you're going to have a portion of the population that needs to be supported by their kids.
Interesting. Oh, that's some big picture stuff to think about there. All right. Well, we'll see if we have any other questions coming up, but I wanted to ask you, Rob, whether there's anything that you've got kind of burning on your mind that you really kind of wanted to get out there today.
I had a question today from Randy. I do need to pull it up. Hopefully I have it here.
I thought you'd have one maybe in your back pocket.
No, he emailed it to me. Randy's very good at this kind of stuff. So I think it is fair to say that depending on your time, I'm going to cut and paste it in the
ticker there.
Question. Yeah. Can I figure this out?
Oh, let's see if Rob will figure out the
tech. I could figure this out. Post a comment? No. Where did I put this? Diggs, do I put it in post a comment?
You just send it to Diggs. He'll post it.
I'll put it in the private chat.
Okay.
So the question is, I think it's fair to say that depending on your time horizon, spending needs, tolerance for risk, appetite, your financial plan must be very personal to you. What about the 4% rule? He's asking about the 4% rule.
Oh, okay.
So some of you guys, so the Canadian Financial Planning Association, I believe that's what it's called, CFP Association, which Adam Buss, head of wealth and estate planning for our team, is, they're strongly suggesting, I believe it's 4.5% or 4.5, maybe 5% rule for drawdown of investments. Did Diego put it in the thing? I don't even know. No, he didn't seem to put it.
Don't see it.
Okay, I'll let him figure that out.
But I think what you should do is kind of explain what that means, that safe withdrawal number.
Sure. When you retire, typically you get a chunk of assets, either through a LIRA, like a locked-in retirement account, a pension, or you built RRSPs, TFSAs, non-registered accounts, or you've sold your business and you get a chunk of cash, or you sell your farm or your house and you get a chunk of cash. You now go into drawdown mode, right? So now you're drawing down on your investment. So the 4% rule is the rule where, if you got $1 million, you draw down 4% of that, $40,000 per year. So the
idea of that rule is that you're limiting it so that you're not eroding your principal, and it's kind of considered kind of like a safe rate over a long period of time. That's the idea, right?
The idea is that it's going to last forever. That's the plan. Now, the problem that I have with it is that CFPs are traditionally extremely conservative and extremely defensive. And I don't want to say neglecting, because they're incredibly bright. Adam is one of the smartest guys, if not the smartest guy I know. Charlie, I'd say, my brother. But Adam is incredibly bright. And you ask him any question about financial planning and he knows it cold. But I wonder what he would say about the 4% rule. But the problem is, if you have a portfolio that's built more like a pension like we build portfolios and has less exposure to traditional fixed income and bonds and GICs, then you should, in my opinion, you should not be using the 4% rule. You should be looking at something higher than that. If you're a defensive investor and you have exclusively fixed income GICs, term deposits, well, then you should be using like the 2% rule. Forget about the 4% rule, right? Now, the difference with the 2% rule is that even if you only spend 2% of your money, you could live 50 years on that money with 0% return, right? So 4% is likely, I'd say, at a minimum, because even if you make 0% return, you could still go 25 years, right, with the 4% rule. So if you're 65 and you retire, you could still go till 90 while making 0% return. So I'm of the view that the 4% rule needs to be a little bit higher. Now, typically they will use it after inflation. So this is a net. And I've seen some both. I've seen some where they use it pre-inflation, some they use it post-inflation. But if you're using it pre-inflation and you're using 2.5% inflation, well, you're left with 1.5% net return, which, if we did that, we'd lose clients. So I don't know. I know some people are only generating 1.5% return, but I think it needs to be expanded. It needs to be looked at. If you have an equity portfolio, if you have some alts, if you have tax efficiency, you could look at using a higher number.
Yeah. And I think that's a pretty kind of safe assumption to make, is that, your asset allocation, your potential downside versus your potential upside is going to make a huge difference. Inflation, all of these things are going to make a big difference. And so, yeah, it's just like anything else. I don't think there should be a cookie cutter rule number. At least I agree with you on that one, Rob.
And Adam is good at that. He never cookie cutters his plans. He always custom makes it and makes sure that, so when we're making a plan for a client, we'll look at their asset allocation. We'll say, okay,
I know what I'm doing. My own back of the napkin retirement plan, I'm sure not using 4% for me.
Yeah. Now, for some people, it's right and it's accurate, but for others, I think it's not.
Yeah.
Did you? The other question that I've been getting a lot lately is home prices. So how do you feel about home prices, Rob? Am I crazy to be getting into the market right now? Is one of the questions I got today for this. So how do you feel about that? Maybe I'll ask you the question and then you can ask me.
Well, I'm in a very unique scenario right now because I'm actually looking at selling my house. So,
but you'll still be in the market, right? You're going from in the market to in the market. So you're laterally moving, right?
I am, but I'm also building. So I don't know if that's a very good combo right now with material prices. But in the end, I mean, look, here's the thing. You got to live your life. So if you've got to move, you've got to move. If you've got to sell your house, you got to sell your house. If you got to buy a house, you got to buy a house. That's my take on it, but I'd love to hear yours.
Well, I'm of the view that it depends. It depends. And I hate saying that answer, but like you look at markets like Vancouver, Toronto, Kelowna, Moncton, where they're up 20% year over year and have been for several years here. I believe an average home detached in Toronto now is 1.1 or 1.2 in Vancouver, something similar. So $1 million detached homes on the average. We're in Winnipeg, so the average detached home here is 375 or something like that. So I think that's dramatically different. So when people around here in Winnipeg ask me about real estate, I tell them that if anything, I'm bullish on Winnipeg real estate, because bullish meaning likely to go up. I'm optimistic because of the significant discrepancy between all the other markets. At some point, you're going to get a firefighter in Vancouver or a school teacher in Toronto say, I can't do this right now. I can't afford this home, or I'm still renting. Hey, if we move to sunny St. Boniface in Winnipeg, Manitoba, we can own a home for 350 grand. Why don't we do that? So I think you're going to get an evening out of the forces, and you can't have a home, because I know what, I know what lumber costs. We follow that very closely, building materials, and you're building out, what that costs. So you could buy some homes in Winnipeg for less than the cost of replacement. So like, that's a pretty bullish sign. So I'm bullish in certain markets. There are many markets in Saskatchewan that are still, I think, undervalued. There are markets in the Maritimes that are undervalued. And there are markets that are likely to continue to grow, but I'm less sure of. Like Toronto, it's very tough to predict the Toronto market, right? But
do you expect that the interest rate hikes might affect things over the next little while?
Well, yeah. I mean, there's a clear correlation. The more expensive money is, like the easier it is, the less people are likely to buy. So my nephew just went through this, Dominic, he just went through this to buy a home, and he was kind of priced out, and it was very hard for them to buy a home in Winnipeg, young couple. But they did it. They found a very nice home, and they're homeowners where they could never ever be homeowners at the age. They're a very young couple in Vancouver or Toronto, right? The homeowners are like 40 years old in Vancouver and Toronto when you can finally afford a home, right?
Yeah, I mean, I went through that exact same thing. I was in my 20s living in Toronto, and you reach a certain point where you got to decide, am I going to get a studio in Toronto, or am I going to get a 5-bedroom house on the river in Winnipeg? And that's what I chose at the time, right? Yeah.
Oh, I see a question here from Rob Mahoney. I definitely want to put this one up.
All right.
This is, I'm going to pound the table here. I got to be careful how aggressive I'm going to be with this answer.
Okay. Rob is asking if CIP covers up to $1 million per brokerage company bankruptcy, is it safer to invest amounts over this with multiple managers? And what would be a good number? 2, 3? Before it would be overkill. Oh, I can't wait to hear I know exactly what you're going to say, but
yeah, you've heard me say it enough times, right? So here's the thing. CIPF is an insurance that all brokerage firms that are members pay into. The insurance covers insolvency of the firm. It covers insolvency of the firm for any assets that are not held on a segregated basis. So assets held by the firm on the client's behalf and cash. Okay. So there's a serious misunderstanding about how this works. I'm going to explain it. So if you have, so if a firm goes bankrupt, if Canaccord Genuity goes bankrupt, we manage, I think it's 100 billion or something like that. We manage, and if somehow we go bankrupt, here's what happens to your investment account if you're with us. And I always tell this to clients if they ask, and I'm always happy to volunteer this information. The assets that you own, the shares of Walmart and Google, and the shares of an ETF that you own, and the shares, the trust units of the alternatives that you own, they're in your name. We're the nominee for that, but they're in your name. You own them. What happens to the firm is irrelevant. You continue to own them. So those portions, that portion of the assets, doesn't touch the CIPF insurance. The only piece that would touch CIPF insurance with us, with our clients, is cash, actual cash, not money market, not short-term fixed income, not short-term bonds, but cash. We don't keep cash in clients' accounts. I mean, if we do, it's it might be a small amount that's accumulated dividends. We like to be fully invested. Typically, we might have a little bit of cash if there's a timing issue or something, but I can't think of a time where we'd have had $1 million in one account. So for us, it's impossible. In my mind, it's impossible that we'd ever have a client who'd ever have to face that. But more importantly, firms don't go bankrupt. And if they do, the last time there was a claim for CIPF, I believe was in the early 90s or late 80s, something like that.
Right. Okay.
And I don't believe, and someone can correct me on this, I'm sure, but I don't believe there's ever been a claim paid out by CIPF. So it's 2 or 3 is absolutely unequivocally unnecessary. If you have your money with the advisor that you trust, whoever that is, Rob, have all that money with that advisor, because you're going to benefit from lower fees. That advisor will be able to build you a real portfolio. That advisor will be able to plan for your wealth to make sure that they know what's happening with your wealth. And you're going to get much better service because you're going to be a larger account, and you're going to have much better tax advice. You're going to get the full picture for everything and better diversification. You're going to have access to more investment opportunities, more investment products, depending on which institution you're at. So unequivocally, there is the way we operate. Let me clarify the way we operate. There's no benefit. Now, if you're with an advisor who keeps 5 or 10 million in cash sitting around in your account for extended periods of time, first of all, I would ask what the heck is going on there. But second of all, you probably want to spread that cash around if it's a firm that you think might go belly up.
Yeah.
So
And
what
I
do
just
you
want to add
to that? Yeah, go
Yeah,
ahead.
I want to add to that, there's diversification across asset classes. There's geographical diversification, but this idea of having all your eggs in one basket, I don't think applies to necessarily brokerage firms. And in fact, I think you can actually get the opposite result of what you want to get by doing that. You could even potentially get yourself in a situation where advisors are taking too much risk because they're trying to compete against each other. Like that can absolutely happen, or perhaps, people would maybe not necessarily take too much risk, but maybe there's, kind of some not fighting or arguing, but it complicates the relationship significantly. And that's the last thing you want with an advisor. You want someone that you unequivocally trust. And if you don't, then you need to reevaluate the relationship. Maybe
If
that's a little tough to say, but
No, I think it's the right thing to say. And
yeah.
if you imagine, put yourself in a situation where you call two advisors and you tell them each, or three or four or five, and you tell them each, I got $1,000,000 for each of you, and I'm going to call you in a year and we'll see how you guys all did. And then I'm going to decide what I want to do with my money. You should never, ever, ever do this, because what do you think is going to happen? So if I'm sitting there, one of five advisors, I know that I can't just build my portfolio that's going to preserve your capital, be tax efficient, make sure to protect the downside, because what's going to happen? Someone's going to take some flyers on crypto or oil and gas or whatever, because if they win the race, they get the rest of the account. So they're going to be enticed to take more risk with your money. And if all five advisors are enticed to take more risk with your money, you have a dramatically higher beta than you would, more risk, more exposure than if you just had the one. So unless you don't trust your advisor, I would never ever put my advisors in a competition.
Yeah, you're essentially getting the opposite result than what you would. You're trying to reduce your risk, and you'd be increasing your risk essentially. So I hope that answers your question, Brian. Oh, it does. And look, he's got another one. Do you think commercial real estate in larger cities is going to fully recover? I hear more and more people are going to work from home permanently. Kind of like working from home sometimes. But anyway, I would like this. I would think this would affect long-term demand, is what Brian is saying.
Yeah. So I think Brian's asking about office space, not the movie. Is it Office Space? What a movie.
Oh, that's a favorite of mine.
Milton, what would you
So
say you do here? I deal with the people. I'm a people person. Anyways, I'm reciting a movie that nobody's seen. If you haven't seen Office Space and you work in an office, watch the movie. It's like mid-90s, would it be, Tanya?
Yeah, yeah.
And Jennifer Aniston, a very young Jennifer Aniston, the guy from
and the TPS reports, and the fax with the printer machine.
There's a whole scene where they just they beat up on a printer because the printer didn't work. It's a guy who gets hypnotized and he hates work and stops caring. And then he gets promoted because he stops caring at work, and he's promoted. And anyways, they end up trying to steal $1 million. And anyways, Office Space, watch it. So Office Space in larger cities, you're right, they are down.
1999, Diggs put the release date. Office Space was released in 99.
Okay, 99. So check it out. You gotta, I don't know if it's on Netflix or yeah, don't touch my Swingline stapler. I'm gonna burn the place down. Diggs, you can maybe let us know if it's on Netflix or Crave or wherever it is. But Winnipeg, I shouldn't say Winnipeg, large city. So, okay, Winnipeg, this city right here, this building that we're in, we're at Portage in Main, the office hub of Winnipeg. And our building is, I don't know, 80% full, people paying rent. And it's probably the parkade when I come in every morning is probably 40% full. So you're right. It's a thing. It's definitely a thing that there's people going to work from home. Right now, there are still long-term leases, and there are still companies that are deciding if they're going to renew or not. They're deciding if this work from home is real, what percentage of their staff. You might get a situation where you just end up getting more space per employee. I've never been a big believer in office retail, or mostly office, because I was always worried about something like this. I didn't really understand that this exactly would happen, but
you're worried about kind of the conditions, economic or just general conditions changing around that.
I've just stayed away from it because I understand multifamily real estate. I get that extremely well. I understand that. And I know that people are always going to have to live somewhere.
Office space has so much more moving parts. There's so many things that have to go right for businesses to rent big office spaces, essentially.
I think what you might see is some of these buildings start to get converted to either industrial or
even residential.
Because what's the best use for this building right here that I'm in right now? I'm at Portage. What's the best use? It's office. But assuming you're not able to charge whatever it is, $40 a foot or $30 a foot to be here, well, maybe Amazon would like to have a distribution center here. I don't know. I'm not an expert there. But if not, then you got to go to residential, because you can't tear this place down, right? It's 34 stories and it's too important. So I don't think you're going to see a complete devaluation of office. I think eventually you're going to see some sort of hybrid solution happening there, but I would not touch personally, I wouldn't touch it with a 10-foot pole. That's just my opinion and just what I've done for a very long time.
All right. Thanks so much, Rob. Now, I am going to, I think, finish off today by telling everyone you can watch Office Space on Crave or Disney Plus. It's a funny
I'll
one.
watch it tonight.
I might too, actually. It's just a nice, funny one to just relax a little bit. So I think we'll call it at that for today. Unless you have anything else that you want to add to this, Rob. We've been at it for about an hour. It went by really fast, right?
I know these things always go by fast, and I end up rambling and whatever. And I'm sorry if I didn't get to your questions and I answered stuff that was too long, but I'll just say this. I keep thinking of like human behavior, and I keep thinking of patterns of behavior that's been proven over time by retail investors. And sorry if I'm repeating myself, but if you're out there, you're likely going to be tempted to sell at the wrong time, and you're likely going to be tempted to buy at the wrong time. It's proven. It's behavioral finance, and we've seen it consistently. So if you're not sure what to do and you're trying to do it on your own, good luck with that. But if not, if you have cash, talk to your advisor and make a plan that's going to make you comfortable with what you're going to do in the market. Once you've established a plan, we're going to do this much now, we're going to do this much in a month, and et cetera, you've then removed emotion from the process.
But can we just talk about how important it is to stick to the plan too, and not be tempted to move away from the plan? Because that is literally the worst thing that you can do. You're guaranteeing yourself an unfavorable result, right?
Yeah, we've seen and done these so many times. Like, this is all we do, right? Is invest. I don't know how many cycles you and I have kind of put money into the market, and we're not always right at the absolute bottom, but we never regret buying when we do buy. And this is something that we're good at because we remove emotion from the process, because unfortunately, we're agnostic to your money, right? We care about it, but we're not emotional about it. So that's the last thing I would say. If you're not sure what to do, pick up the phone, call your advisor and make a plan. And if you don't have a plan with your advisor, if they're giving you the old, we got stuff, and well, maybe it's time you switched advisors, and we're always looking for new clients. So don't hesitate to go to www.speaktotanya.com and www.speaktorob.com to book a no obligation consultation if you'd like to chat with us about this or anything else that's on your mind.
All right. Have a wonderful night, everyone. We'll see you next time.